It is time for...
This is Hit My Portfolio. Hit My Portfolio.
That's right. We have our expert in the studio and a community member on the line ready to get their portfolio pimped. Luke Larrity from Seneca is here with us as our expert today. Luke, welcome.
Bryce, Alec, how are you, mate?
We are well.
Good.
And we have Jazz on the line. Jazz, welcome to Pimp My Portfolio and Equity Mates.
Hi, it's nice to be here.
Yes, we're excited for this one. Quite a diverse portfolio. So, Ren, why don't you give us a bit of an explanation as to what we have in front of us?
Okay, so Jazz's portfolio looks like a classic core and satellite approach. A bit over 70% of the portfolio is in ETFs, and then the remaining about 30% is in individual stocks. 11 ETFs, the biggest, the Vanguard Total Stock Market Index, the Vanguard International Shares, and the Vanguard Australian Shares. So some broad-based ETFs there. On the individual stock side, 17 individual stocks, including some of the biggest Aussie stocks, BHP and Commonwealth Bank are in there. Also some of the big US stocks, Microsoft and Google, Johnson & Johnson. The belle of the ball when it comes to the stock market is in the fund. Nvidia is in there. So, Jazz, you must be loving that. A big mix of ETFs and stocks. Now, how we always like to play this is, Luke, you'll give us a nickname, and then, Jazz, we will hear how this fund, this portfolio came to be. So, Luke, what have you got?
All right, you stole my thunder. I'm going to call it the core plus scattergun.
Okay.
So that's what I've called it. Sorry, Jazz. You really should have got Dawsey. So you know, I kind of like the overall strategy, like real high level kind of strategy, and I think there's probably some things we can do on execution that would sharpen the knife a little bit.
So, Jazz, the core plus scattergun is the name of your portfolio. How do you respond to that? And I guess, how have you come to build this portfolio over time?
At least it's not scatterbrain.
I wouldn't do that to you, Jazz. I wouldn't do that to you.
Because, to be honest, I'm a very impulsive person. If I do like the stock, I don't look into it much further and just tend to buy it right away. I know it's very...
Sounds like a Ren, to be honest.
Jazz, we're all good. We're all good.
Like,
Don't listen to it.
Can't not buy a stock.
I can't wait to do your portfolios, boys. I'm going to go so hard.
Nice. So, impulsive, if you like it, you buy it. What else?
And then I have quite a big FOMO as well when it comes to stock.
Ooh, the FOMO is a dangerous one.
I know it's so bad. Like, yeah.
I think
we all feel it at times.
Yeah, even I catch it on occasion. It's definitely hard sometimes.
Just on that though,
Yeah.
so Jazz, I can understand that from a individual stock point of view, but you've done pretty well, I guess, still maintaining at least 70% in core ETFs. So what's been the strategy behind that part, like FOMO of ETFs and just hearing people talk about them and buying them, or what's the strategy behind the ETFs?
So I've been listening to lots of podcasts for finance. I think it's because COVID, I went down this rabbit hole of personal finance, and then I've been hearing about the core strategy and the satellite. So the core and satellite portfolio. So when it comes to core, I just find anything broad-based, dump my money in there, and then don't have to look into it. That's how I came about with 11 ETFs that probably overlap.
I definitely
do. Yeah. Yeah. Mm-hmm. And then when it comes to satellite, I just choose whatever that sounds interesting to me. I believe I bought in Moderna before they released the news of the vaccine. I remember that specifically.
Nice.
I just bought in a random things that some like I've been seeing on YouTube or any some people saying about these kind of stocks. But lately I've been pulling it back and decided, you know what, I just want to retire with enough passive income. So I'm just looking into the dividend kind of stock.
Okay.
Nice,
Nice.
nice. All right.
Mhm.
So, look, where do we want to start? Maybe with the ETFs?
Yeah, I think, okay, so yes, there's lots of overlap in these ETFs. You can probably just simplify this down to, something that's going to work for you, which would be either a multi-asset ETF like that total stock market index fund that you've got, which is going to cover international and Australian shares and emerging markets and everything. So you could probably look to just consolidate or put new funds in there or whatever you decide to do. But that would probably solve a lot of issues for you. You don't need to be running off and doing high dividend yield index and IVV or as QQQ. Like you don't need any of this stuff. You can just go one or two really broad-based, low-cost ETFs and sort of simplify, one, your tax return at the end of the year, but also your own thinking. And that's going to free up brain space to do stuff that's interesting to you, that hopefully is going to add value, and worst-case scenario is going to help you learn, which is kind of that's realistically what core satellite is. It's doing what you're supposed to do, but then having some money in stuff that might not be the optimal way to invest, but either scratches an entertainment itch, helps you learn, keeps you from doing sillier things with the bulk of your money, so on and so forth. So think about it like that. I've got no real comments on like 70-30 or 50-50 from how much should you have in your core and your satellite. It's really up to everyone individually, and no one can probably tell you that answer. I would say with stock picking and buying individual shares, I would try and find a couple of active managers that you can read the monthly reports from, who you can maybe dial into a webinar every so often and scratch the itch of owning stocks directly that way. You are just not going to be competitive buying shares in any of these companies, whether you've made money or not, with that investment process, and or lack of process. I did a quick scan on my little database and worked out that there are 28 on average, 28 paid, I'm talking really well paid analysts around the world on average covering each one of those stocks that you own. So that's 28 people who get paid for a living to research everything there is to know about Moderna. Do you think you know more or less about the company than those 28 people?
Well, Jazz said she got them before the vaccine
I'm
came out,
just
so it
saying-
sounds
I'm
like
just-
she knows a bit more.
Maybe, right? But what's the luck skill continuum there,
course,
right?
of
So
course. Yeah,
so
yeah,
all
yeah.
I'm saying here is that I'm not like trying to be funny or whatever, but all I'm trying to say is that these are heavily researched, global, large cap, billions and billions of dollars at stake every day. It is unlikely that a at-home investor on the other side of the world is going to have any competitive advantage in Microsoft. It's just not realistic. So I think that whilst certainly they can be good investments, and I'm not making any comment about Moderna or Microsoft or anything, all I'm saying is that is the ability to generate an edge there is going to be low. Maybe choose someone who A, may be able to find an edge, or B, just focus on the core. And the core is going to have those stocks in there anyway for you, and you're going to generate good returns doing that. So, you make enough bets here, and when you started investing, this stuff might have worked. Roll forward 2 years, it may not be working for you anymore. And then at that point, it's going to be too late, and you're going to be upset about it. So,
You mentioned their income as well, and I think one of the advisors we've had on earlier, or I can't remember where I read it, but you need like reasonably significant positions in one or two to start properly generating income, rather than a little bit here and a little bit there. And interestingly, the Vanguard stock market, the total stock market index ETF, pays quarterly dividends. Their last dividend was 91 cents a share. The quarter before was $1. So you can see where you start building up a significant position in that. Not only are you getting decent income across the year, but you're getting exposure to almost all of the other ETF positions that you have, but much more, building a larger position, Jazz. Does that make sense?
on a tax neutralized basis,
Yep.
the capital gains and income should be thought of the same. So if your tax rate's zero, if I make a $10 share price gain out of a $20 share, the share price is going to go down to $10 and I'm going to get $10 in my pocket. So, capital growth and dividends are the same. The only difference is that share price or capital gains can be more volatile than dividends, because they're priced every day rather than priced once a quarter or a half or a full year. So it can feel safe looking for a dividend, but a dividend can be cut. A dividend can be stopped. A dividend can be turned off. So dividends are a percentage of profits. And if you take a company that's consistently paying dividends above its profits, eventually it's going to run out of money. So I just think that thinking of dividends as an income, if you're still working and your tax rate is still above zero, then sure. But I think we need to just make sure that conversation's really start going into the personal advice, thinking about your own situation world. But I just would like that concept of, on a tax equal basis, zero tax environment basis, capital growth and income is the same.
Yeah. I think the other thing is, because it's certainly, Jazz, you're certainly not alone in the search for income at the moment. It's a big conversation in the Facebook group and the Equity Mates community more generally now.
Why now?
Well, I think partly of a flight to safety, like a lot of growth stocks aren't doing as well. But I think everyone, when they think long term, they think there's this really nice idea of having a portfolio that pays a nice passive income. And so a lot of people are now thinking about, what are those, bond funds or whatever it is, income paying investments that can do that. But the way I approach it is when we're in our 20s and our 30s and we're in the growth phase, it's about just getting the portfolio as big as possible and focusing on growth. And then you can worry about setting it up for income much further down the road when you've got more assets. Like right now, if I tried to set my portfolio up for income, it wouldn't be anything super exciting. So I'm focused on growth, focused on growing the pie. And then later in my life, I can be all right, well now let's turn on income.
I think the other thing with income generating high dividend, high payout ratio companies, they are inherently not growing. That is why they are returning capital to shareholders. It is because they don't have anything better to do with the money. So they're giving it back to you as a shareholder. So, if you're picking a company here off the top of my head, Breville, and you're going to reinvest in a geographic expansion and R&D for coffee machines and grow your business by 15% or 20% or 30%, well, you're not going to return most of your free cash flow to shareholders because you're going to need that money for R&D and geographic expansion and hiring new people and buying parts and so on and so forth. So, and that's going to generate 30% on a bigger base. And so, businesses that we talk about return on invested capital and an ROE and all these good sort of concepts. Well, they only work when you reinvest at higher and higher rates of return. And you can only do that by not paying dividends or paying very, relatively low dividends. So I think, sure, you can buy a company for a dividend yield, but you are inherently buying a mature business that is going to be growing at much slower rates, like a GDP plus type rate of growth rather than a double-digit rate of growth.
So, Jazz, a lot of things to think about there. I think the first thing was, your 70-30 core satellite, you're building the building blocks of something that will hold you in good stead. I think on the core side, the feedback was 11 ETFs is probably too many. You can probably think about where they overlap and how you can get the exposure you want, but just with less complexity. And then on the individual stock side, I think Luke had some good points around, can an active manager replace some of that exposure? And if you do want to invest in individual companies, probably having less and focusing more on ones that you want to really understand in a lot more detail.
Go smaller as well. I think that's the other thing. I think people do this direct stock investing and they go for the big names that they know with 30 analysts covering the stock.
And work on that FOMO.
Nah, nothing wrong with
a bit of FOMO as well.
Investing's exciting. Embrace the emotion of it. I'm with you, Jazz.
Work on that FOMO.
So what's the next promo? The ETF for Bitcoin and Ethereum?
No. Not while Luke's in the house. No.
Nothing to see here. Anyway, Jazz, plenty to think about. Hope you got some value out of that conversation. And of course, you can speak to Luke directly if you would like more advice. We're happy to connect you. And if you're listening at home and would like to be connected with Luke or any of the other advisors, head to equitymates.com/advice and we'll get you in touch. But Jazz, thank you so much. Absolute pleasure having you on today. We do really appreciate you submitting and all the best with it.
Yep, thank you for having me. It's been a pleasure.
Nice. Thanks, Jazz.
Well done, Jazz. Thank you.
Thanks, Jazz.
Thank you.
Equity Minds.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.